Welcome to the Deep Dive. We're here to cut through the noise and get to the heart of financial performance.
That's right.
Today, we're taking a close look at UniFirst, the uniform provider, ticker's UNF.
Yep. Got their latest numbers right here.
So the plan is simple. Unpack the recent earnings report, look at the outlook, and figure out what it all means. For the company, sure, but also for the wider market.
Exactly. We're digging into the financial reports, the analysis, aiming to give you the key takeaways. No jargon, just the insights.
All right, let's dive in. Let's unravel this thing. So, kicking things off with UniFirst's latest quarter. They reported earnings of $2.17 per share.
Okay.
And here's where it gets interesting. Right away, that number actually beat the Zacks consensus estimate. Analysts were looking for $2.12. So that's an earnings surprise of, plus 2.36%. They came in higher than expected. Pretty solid start, wouldn't you say?
It is a solid beat against the estimate, yeah. But what's kind of fascinating here is context. If you look back a year ago, their earnings were actually $2.19 per share then. So yes, they beat this quarter's prediction, but it's a slight dip compared to last year's actual earnings.
Oh, right. So better than expected now, but not quite as good as a year ago. That's nuanced.
It is. It suggests maybe they managed costs really well this quarter, perhaps?
A nuanced picture, yeah.
Yeah.
But UniFirst, they seem to have a knack for this, looking at their recent history. Over the last 4 quarters, they've surpassed the consensus EPS estimates 4 times.
Yeah.
Every single time.
That's quite a streak.
It really is.
Yeah.
Just last quarter, the surprise was even bigger, nearly 7%. $1.40 fast actual versus the $1.31 expected.
Yeah.
So this consistency, it's not just random, right? Are they just really good at managing expectations or costs, or is there something deeper analysts keep missing?
Well, that level of consistency often points towards, strong operational control, maybe a bit conservative on their guidance too, which they then reliably beat.
Makes sense.
However, when you switch over and look at revenue, the picture changes a bit.
Okay, how so?
For this same quarter, the one ending May 2025, revenues came in at $610.78 million. And that actually missed the Zacks estimate.
Oh, by how much?
Just slightly, by 0.36%. But still, a miss. For context, a year ago, revenues were $603.33 million, so there was year-over-year growth.
So we've got this, interesting mix then. They keep beating on earnings consistently,
Right.
but missed on revenue this quarter. And looking back, they've only topped revenue estimates twice in the last 4 quarters versus 4 times for earnings.
Exactly.
So what does that combo, strong earnings but a slight revenue miss, really signal? What should an investor take away from that?
Yeah, that's a really good question. It raises flags about the quality of the earnings beat sometimes.
How do you mean?
Well, an earnings beat with a revenue miss can suggest profitability might be coming more from, say, cutting costs or internal efficiencies rather than strong sales growth driving the business forward.
Okay, so less about growing the pie, more about slicing it efficiently.
Sort of, yeah. And a lot hinges on what management says next. Their commentary on the earnings call, their forward guidance, that's going to be crucial for how the market reacts and what future expectations look like.
Right, the narrative they spin around these numbers.
Precisely. That commentary is key.
Okay, speaking of what's next,
Yeah.
let's look at the stock itself. UniFirst shares, UNFINF. They've actually had a pretty decent run this year, up about 11.3% since the start of the year.
And that's definitely worth highlighting, especially when you compare it to the broader market.
Right.
The S&P 500 gained, 5.4% over that same period. So UniFirst has clearly outperformed the market overall, year to date anyway.
Which brings us to the big question for anyone looking at this stock. Okay, so what happens next? How do you even start to figure that out, especially with this mixed picture we've just painted?
Yeah, that's always the million-dollar question, isn't it? And look, there are no crystal balls. But a company's earnings outlook is generally seen as a pretty reliable indicator.
Yeah, outlook, okay.
Yeah, and it's not just about the current consensus numbers for future quarters. It's also, crucially, about how those expectations have been changing. Have analysts been raising their estimates or lowering them?
The trend?
Exactly. There's solid research showing a strong link between near-term stock moves and the trends in these earnings estimate revisions. It basically reflects how the experts are adjusting their views in real time.
And for listeners wanting to track that sort of thing, tools like the Zacks rank can be useful, right?
They certainly can help synthesize that revision activity. So just before this earnings report came out, UniFirst had a Zacks rank #3.
What do you mean?
The scale goes from #1, strong buy, down to #5, strong sell. #3 is hold. It basically suggests that based on those analyst revisions, the stock is expected to perform more or less in line with the overall market in the near term.
Okay, a hold. And what are the actual numbers analysts are expecting now?
Well, looking ahead, the current consensus for the coming quarter is for earnings per share of 2.02 cents on about $605 million in revenue. And for the full current fiscal year, they're looking at 7.94 EPS on $2.43 billion in revenue.
Got it. But, it's never just about the company itself. We always need to look at the bigger picture, the industry it's in.
Absolutely vital. A company, no matter how well it's run, can face major headwinds just because of the sector it operates in, or tailwinds for that matter.
So UniFirst is in the Zacks uniform and related industry. How's that sector doing overall?
Well, that's where things get a bit concerning. The uniform and related industry, it's currently ranks in the bottom 5% of all the 250-plus industries that Zacks tracks.
Wow, bottom 5%. That's not great.
No, it's not. And our research consistently shows this matters a lot. The top half of Zacks-ranked industries tends to outperform the bottom half by a factor of more than 2 to 1.
So UniFirst is swimming against a pretty strong current then.
Definitely. It makes their individual performance, like that stock outperformance we mentioned, even more interesting, frankly. They're doing well despite the sector struggles.
Okay, that's a really important piece of context. Maybe to understand the sector better, let's pull in another company. Protolabs, PRLB. They're in the broader industrial products sector, like UniFirst.
Good comparison point. Yeah, Protolabs, PRLB. They're expected to report soon, too.
What are the expectations there?
For the quarter ending June 2025, analysts expect them to post earnings of $0.33 per share. Now, that would actually be a year-over-year decrease of about 13.2%.
A decrease, okay. Any recent changes in those estimates?
Interestingly, no. The consensus EPS estimate for Protolabs has stayed flat over the last 30 days. Suggests analysts aren't seeing much to change their view right now.
And what about Protolabs revenue?
Expected revenues are around $127 million. That would be up slightly, about 1.1%, compared to the same quarter last year.
So Protolabs looks like it's maybe feeling those sector headwinds more directly with declining earnings expected?
It seems that way, yeah. A different picture than UniFirst's earnings beat.
So putting it all together, what does this contrast really tell us about UniFirst Spot? Is their strength, their resilience, something sustainable? Or are they just, maybe delaying the inevitable drag from a tough industry?
That really is the key question, isn't it? It suggests UniFirst definitely has some specific advantages, maybe strong customer relationships, maybe a particular niche they dominate, that are buffering them from those wider industry problems, for now at least.
Right. But how long can that last?
Nobody knows for sure. No company is totally immune forever.
Okay, so let's try to wrap this up for you, the listener. We've looked at UniFirst. Strong earnings beat this quarter. Great stock performance this year so far. Definitely beating the market.
Yeah.
But there was that slight revenue miss.
Yeah.
And, maybe more importantly, they're operating in an industry that's, well, frankly, struggling. Bottom 5%.
Right. Which leads us to the final thought, something for you to really chew on. How do you weigh these things? When you see a company like UniFirst showing real individual strength, beating earnings, outperforming the market, how do you balance that against the fact that its entire industry is facing significant headwinds? What does it actually mean for a company to hold or even to thrive when its sector is under so much pressure? And what could that signal about their strategy for the long haul?